What if I told you that the moment you signed your mortgage papers, you unknowingly agreed to pay for your home twice? Not almost twice, not roughly twice, twice. And the worst part? Your bank knew this on day one, handed you the paperwork with a smile, and never once sat you down to explain what the numbers actually meant over the full life of that loan. Today, that changes, because by the end of this video, you are going to see your mortgage in a completely different light, and you are going to have the tools to do something about it. I'm Gabrielle, a chartered professional accountant and founder of a tax-specialized accounting firm. I've spent years sitting across from people who work hard, earn good money, and still feel like they can never quite get ahead financially. And one of the biggest reasons for that, one of the most consistent patterns I see, is that people are carrying an enormous amount of mortgage interest without fully understanding how much it's actually costing them. So today, I'm pulling back the curtain completely. We're going to talk about how mortgage interest really works, how much of your hard-earned money is quietly disappearing every single month, and the 3 strategies that can save you anywhere from $60,000 to over $100,000 depending on your situation. Let's get into it. Let's start with something that sounds simple but has layers to it that most people have never really thought through. When you make your mortgage payment every single month, that payment is doing 2 completely different things at the same time. One portion is going toward your principal. That is the actual amount of money you borrowed from the bank to buy your home. That portion is yours. Every dollar that goes to principal is a dollar of real equity, a dollar closer to owning your home outright. But the other portion, and this is the part that nobody talks about loudly enough, goes toward interest. And interest is not yours. Interest is the bank's fee for lending you the money. It builds no equity, it does not reduce what you owe, it is simply the cost of borrowing, and it is collected by the bank every single month without exception. Now here is where it gets uncomfortable. The split between principal and interest in your monthly payment is not equal, not even close, especially in the early years of your mortgage. When you first take out a mortgage, the vast majority of your monthly payment goes straight to interest, and only a small fraction actually reduces your balance. We are talking about a situation where you could be sending the bank $2,000 a month and only $400 to $500 of that is actually paying off what you owe. The rest, $1,500 or more, is pure interest income for the bank, month after month, year after year. This is not an accident. This is how the amortization system is designed, and it is extraordinarily profitable for lenders. The reason this happens comes down to how interest is calculated. Every month, your interest charge is based on your current remaining balance. At the very beginning of your mortgage, that balance is at its absolute highest, so the interest charge is also at its highest. As you slowly pay down the principal over time, the interest charge gradually decreases and more of your payment starts going toward the actual debt. But this shift happens very slowly. In the early years of a 30-year mortgage, you can feel like you are barely making a dent because you genuinely are barely making a dent. The math is stacked against you from the start, unless you know how to push back. And then there's the amortization period to consider. In Canada, the standard is 25 years. In the United States, it is 30 years. These long timelines exist primarily to make monthly payments feel affordable, and they do accomplish that. But they come at an enormous hidden cost that almost nobody fully internalizes when they are sitting at the closing table. The longer you stretch out the repayment period, the more months the bank gets to charge you interest on that outstanding balance. A longer amortization means lower monthly payments, yes, but it also means dramatically more total interest paid over the life of the loan. The bank wins both ways. You pay less each month so you feel comfortable, but you pay for so many more months that the total cost is staggering. Let me give you the numbers that I genuinely believe every single homeowner needs to see at least once. Take a $400,000 mortgage at 5% interest over 30 years. Your fixed monthly payment comes out to approximately $2,147. That feels manageable for a lot of people, maybe even reasonable. But here's what that payment actually adds up to over the full 30 years. Your total payments across the entire life of the loan come to approximately $773,000. You borrowed $400,000. You will pay back $773,000. The difference, $373,000, goes entirely to interest, not to your home, not to your equity, to the bank. In interest alone, you are paying an amount that is almost identical to the original size of your loan. You are essentially buying your home twice, and the second purchase gets you absolutely nothing tangible in return. I want you to think about what $373,000 actually represents. That is a fully funded retirement account for many people. That is your children's university education paid for multiple times over. That is a second property. That is financial freedom, sitting right there in a number that most people never actually confront because no one ever laid it out this clearly for them. This is the real cost of your mortgage, and this is what is at stake when we talk about strategies to pay it off early. Now let's shift gears completely because this is where the video gets genuinely exciting. Everything I've shown you so far represents what happens if you do nothing, if you just make the minimum payment every month for 30 years and never think strategically about your mortgage. But you don't have to do nothing. There are 3 specific strategies that can dramatically change this outcome, and I'm going to walk you through each one in detail with real numbers so you can see exactly what the impact looks like. The first strategy is the lump sum payment. This means taking a meaningful amount of money, a tax refund, a work bonus, savings you've accumulated, proceeds from selling something, and applying it directly to your mortgage principal all at once, not to your regular payment, directly to the principal balance. The reason this is so powerful is that it immediately reduces the amount the bank is calculating your interest on every single month going forward. It's a permanent reduction that compounds in your favor for the entire remaining life of your mortgage. Here's what this looks like in practice. Let's say you apply an extra $20,000 to your $400,000 mortgage, bringing the balance down to $380,000. You keep making the exact same monthly payment of $2,147. Nothing else changes. But because your balance is now lower, more of every future payment goes toward principal instead of interest, right from the very first month after that lump sum. The result of this one decision, you pay off your mortgage in approximately 26.8 years instead of 30, and your total interest paid drops from $373,000 to around $310,000. You just saved over $62,000 with a single payment, one transfer of funds, one intentional decision, and the financial impact echoes across the next 3 decades of your life. There is something critical to know before you do this, though. Most lenders have what are called prepayment privileges, limits on how much extra you are allowed to put toward your mortgage in any given year without triggering a penalty. A very common limit is 20% of your original mortgage balance per year. On a $400,000 mortgage, that works out to $80,000. So a $20,000 lump sum is well within the limit and completely penalty-free. But if you were thinking about putting down a much larger amount, you need to check your mortgage agreement first. Exceeding the prepayment limit can significantly reduce or even eliminate your interest savings. Always verify your prepayment privileges before making any large extra payment. One phone call to your lender can save you from a very unpleasant surprise. The second strategy is making consistent extra monthly payments toward your principal. And I want to be upfront with you. When I first ran these numbers, even I was surprised by how powerful this turned out to be. We are talking about adding an extra $200 per month to your mortgage payment, applied directly to the principal. That's it. $200. For context, that is less than what many households spend on streaming subscriptions, takeout meals, or impulse purchases in a given month. It is a number that most people could find with a small amount of intentionality around their budget, and the impact it has over the life of a mortgage is genuinely remarkable. Adding $200 per month to your principal payment means you pay off your mortgage in approximately 24.8 years, more than 5 full years ahead of the original 30-year schedule. And your total interest paid drops from $373,000 to approximately $298,000, a saving of around $74,000. Not $62,000 like the lump sum, $74,000. The consistent monthly extra payment actually outperforms the one-time $20,000 lump sum over the long run, and the reason why comes back to the power of compounding working continuously in your favor. Every month, that extra $200 reduces your principal. Every month, the interest charge is a little bit lower, and every month, slightly more of your regular payment also goes to principal. It builds on itself month after month for years. Now, there is one thing you absolutely must get right for this strategy to work properly, and it is worth emphasizing strongly because getting it wrong completely undermines the whole approach.
When you set up an extra payment with your bank, you need to confirm explicitly that it is being applied to the principal only, not being processed as a regular mortgage payment that gets split between principal and interest the way your normal payment does. Some banks, if not specifically instructed otherwise, will apply the extra amount as if it were just another regular payment, which means a portion of it still goes to interest and you lose much of the benefit. Call your bank, go online, talk to your mortgage advisor, whatever it takes, and make absolutely sure those extra dollars are hitting your principal balance directly. This one step is the difference between saving $74,000 and saving a fraction of that. The third strategy is switching from monthly payments to bi-weekly payments. This one is my personal favorite because of how effortless it is once it is set up. The concept is simple. Instead of making one full mortgage payment every month, you split your monthly payment exactly in half and make a payment every 2 weeks. So instead of paying $2,147 once a month, you pay $1,073.50 every 2 weeks. On the surface, this might seem like it should be mathematically equivalent, but here's the insight that makes all the difference. There are 52 weeks in a year. If you're making a payment every 2 weeks, you make 26 payments over the course of the year. 26 payments at half the monthly amount is the same as 13 full monthly payments. But if you were paying monthly, you would only make 12 full payments. So by switching to bi-weekly, you're automatically making one complete extra mortgage payment every single year, and you barely notice it because it just flows naturally out of your regular paycheck cycle. There's no extra money required, no budget adjustment needed. You're simply paying the same total amount in a slightly different rhythm, and that rhythm quietly generates one additional full mortgage payment per year every year for the life of your mortgage. The numbers on this are compelling. In our example, switching to bi-weekly payments alone means you pay off your mortgage in approximately 25.2 years instead of 30, and you save around $68,500 in total interest. Nearly 5 years off your mortgage and almost $70,000 saved without spending a single extra dollar, just a smarter payment schedule. This is honestly one of the most underutilized strategies in personal finance, and the reason more people don't do it is simply that they don't know about it. Now you do. Set it up this week. Call your bank tomorrow morning if you have to. It is that straightforward, and the long-term payoff is enormous.
Now, let's look at all 3 strategies together because the individual numbers are impressive, but the real magic happens when you combine them. Lump sum payments saves you $62,000 and cuts 3.2 years off your mortgage. Extra monthly payments of $200 save you $74,000 and cut more than 5 years off. Bi-weekly payments save you $68,500 and cut nearly 5 years off. Each one is powerful on its own, but imagine deploying all 3 simultaneously. You redirect your tax refund toward the principal every year. You find $200 a month in your budget and apply it consistently. You switch to bi-weekly payments and let the calendar do its work. The combined effect of all 3 strategies working together could take a 30-year mortgage and turn it into something closer to 18 or 19 years, with total interest savings that could well exceed $100,000. That is not a small adjustment to your financial life. That is a transformation. And I want to paint a picture of what that transformation actually looks like in real life, because this is ultimately not about numbers on a spreadsheet. It is about what your life feels like when your mortgage is gone. Think about the single largest monthly expense in your household budget right now. For most people, it is the mortgage. Now imagine that expense disappearing, not reducing, not getting smaller, completely disappearing 5, 8, 10 years earlier than it was supposed to. What does that free up? What does that make possible? Maybe it means you can actually max out your retirement contributions for the first time. Maybe it means one parent can step back from work and be more present with young children. Maybe it means you can take the risk of starting the business you've always thought about. Maybe it simply means you sleep better at night knowing that no matter what happens with your job, your health, or the economy, you own your home and nobody can take it from you. Financial freedom is not one single dramatic moment. It is a series of informed decisions made consistently over time. Paying off your mortgage early is one of the most impactful of those decisions, and unlike a lot of financial strategies that require perfect market timing or complex investment knowledge, this one is completely within your control. The strategies work regardless of what the stock market does. They work regardless of what interest rates do next year. They work because the math is simple, the rules are predictable, and every extra dollar you put toward your principal today saves you multiple dollars in interest over the years ahead. So here's what I want you to do right now.
Don't let this be another video you watched and found interesting and then forgot about by tomorrow morning. Take one concrete action today. Call your bank and ask about switching to bi-weekly payments. Look at your budget and identify where $100 or $200 a month might be hiding. Check what your prepayment privileges are so you are ready when a lump sum opportunity comes along. Start somewhere. Start small if you have to, but start. Your mortgage does not have to be a 30-year sentence. With the right knowledge and a little bit of intentionality, it can be something you walk away from years ahead of schedule, with tens of thousands of dollars still in your pocket that would otherwise have gone straight to the bank. That is what financial freedom looks like in practice, and you are a lot closer to it than you probably think. If this video opened your eyes to something important, please hit the thumbs up button and subscribe, because we are so close to 100,000 subscribers, and this community is built on exactly this kind of honest, practical financial conversation. I will see you in the next one.